Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us live from the market site in Times Square, New York City, we have Phil Mackintosh, chief economist at Nasdaq. We're going to talk about earnings and why it's such a key data point, especially for what we have going on in a macro perspective. And Phil, great to see you as always. This is always the highlight of the week now that we're back in studio. Let's start with where stocks and rates and how they've performed over the last week.
Yeah, so I mean, just decided this week to kind of wind back 3 months because really where we're trading in the stock market now is where we were 3 months ago. We've kind of hit all-time highs and now we're coming back. And so obviously the stock market has a few headwinds, and one of those is what's going on in interest rates. So if you look at the 10-year yield, about 3 months ago, it was down at 1.2%. It's now back up to 1.6%. And so as rates rise, that creates a headwind for stock valuations.
Right, and so we had the unofficial start of earnings this week, of course, with the big banks kicking it off. It's almost refreshing to have something else to talk about besides interest rates and inflation. Why is this particular earnings period going to be so important?
Well, ironically, because of interest rates and inflation. So if you think about historically where stocks have been valued, like we're very close to all-time highs, which has a lot of people asking if stocks are rich. But if you look at, we've done a scatter plot today of all of the different marks of the price-earnings ratio over time, you find that as rates go down, the valuations of the market tend to go up. And where we are right now is pretty close to that grey trend line. But we're also pretty close to some of those purple dots in the chart, which are the tech bubble. So people are wondering whether we're in a tech bubble or are we actually in a fairly valued market. And the reality is, because interest rates are so low, we're pretty close to fairly valued. So that's the first thing that's really important. As we see rates go up, we should sort of slide down that trend line, which means really the prices will fall if earnings don't go up. And that's the link back to earnings, is we need earnings to support valuations. So that's why we're talking about earnings.
And then you cited a recent survey showed that a multi-decade record number of companies are planning to increase prices. So the question is that's going to be enough to offset the cost?
Yeah, so that's the interesting part right now about this earnings season. The good news is the expectations for earnings are still really strong, but not quite as strong as the last 2 quarters. And one of the reasons for that is, like you said, we've got some costs coming through. So we've got a lot of labor shortages, wages are going up. We've had some supply chain shortages, input prices are going up. That's increasing the cost. So unless companies increase prices, their profits get squeezed. And so that's what's going to be really interesting to see about Q3 earnings, is whether all of those cost increases are squeezing margin or whether companies are actually starting to increase their revenues, increase their prices, increase earnings, valuations are okay.
Should be interesting to hear what comes out in the conference calls and guidance, that's for sure. All right, Phil, thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.